On February 6 in Washington, before representatives of more than 50 nations, a phrase was spoken that does not belong to the traditional vocabulary of free markets: a price floor for strategic metals. This was not articulated in an academic paper or a theoretical framework, but in the very environment where policy is formulated. If you are holding US dollars, foreign currencies, gold, or silver, this is not a moment to be casually dismissed. Because the central question is no longer how prices may fluctuate, but whether the prices currently observed are still being set by market forces, or by an emerging order operating behind them. Immediately after the phrase "price floor for strategic metals" was voiced in Washington, what was most striking was not the market's response, but its absence. There were no anomalous candlesticks, no cascade of urgent headlines, no familiar scenes of panic. Yet this absence itself is indicative of a deeper shift. When change is genuinely structural in nature, it rarely announces itself through immediate volatility. Instead, it begins with subtle adjustments in how decisions are made behind closed doors. If one situates oneself not in front of a price chart, but inside the meeting room itself, it becomes clear that this was not a rhetorical statement or a political slogan. It was the language of risk management. The individuals in that room were not debating today's price or next week's movement. They were addressing a more fundamental question. What happens when a critical supply chain is constricted at the very moment demand is accelerating and production capacity cannot adjust in time? Framed in this way, price ceases to function as a market variable and instead becomes an instrument of policy. From this perspective, a price floor does not represent a blunt or crude intervention. Rather, it is an attempt to redefine the boundaries of acceptable risk. In applied economics, price floors are not employed when markets are operating smoothly. They emerge only when decision-makers conclude that allowing the market to continue adjusting freely would impose greater long-term costs than the short-term efficiencies it delivers. This signals that the underlying concern is not excessively high prices, but persistently low prices that undermine the productive base itself. Silver enters this discussion not as a symbolic asset, but as a functional one. In many modern systems, silver is not an optimal choice. It is an indispensable one. Across electrification, data centers, transmission infrastructure, and advanced technological applications, silver does not appear prominently at the surface. Yet it is embedded within conductive layers and critical connections, without which these systems cannot function. This structural invisibility has allowed silver to be underestimated for extended periods, until supply chains begin to tighten and constraints become visible. At this stage, the narrative is no longer centered on mining. Mining is merely the starting point. Real leverage resides in refining, standardization, and integration into production chains. This segment of the value chain receives limited attention because it is neither glamorous nor rapid, and it carries significant complexity. Refining requires substantial capital investment, long development timelines, and tolerance for environmental and regulatory risk. For years, many countries chose to avoid this stage, relying instead on global markets to compensate. In a stable geopolitical environment, that choice is rational. In a fragmented one, it becomes a strategic vulnerability. It is precisely at this point of vulnerability that a price floor acquires meaning. It does not guarantee profitability, but it establishes a safety margin sufficient to prevent long-term projects from being destroyed by a downward price cycle. Crucially, this does not occur in isolation. When a minimum price is introduced into policy discussions, the entire value chain must recalibrate expectations. Producers perceive a degree of protection. Consumers anticipate potential cost pressures. Financial markets, in turn, reassess risk using a fundamentally different framework. Here, a critical inflection emerges. In prior cycles, silver markets were highly sensitive to monetary policy, particularly interest rates and liquidity conditions. In the current environment, however, silver increasingly responds to industrial policy and supply chain security considerations. This shift does not eliminate silver's monetary dimension. It complicates it. Silver no longer reflects only inflation expectations or hedging demand, but also the degree of strain within the physical economy itself. Within this framework, the US dollar neither disappears nor remains external to the process. As nations consider measures to protect strategic resources, they must also account for the currency in which those resources are priced. A dollar-denominated price floor introduces exchange rate exposure, financing costs, and dependence on the monetary policy of another economy. This does not imply an erosion of the dollar's central role, but it does indicate that the dollar is increasingly incorporated into long-term strategic calculations, rather than treated as an immutable foundation. Gold, meanwhile, reappears as a familiar reference point, not because it is expected to replace the existing system, but because it represents an asset independent of any counterparty promise. Positioned between gold and industrial metals, silver becomes a particularly sensitive indicator of these structural shifts. When policy and markets exert simultaneous influence, silver often reacts first, not dramatically, but decisively for those who observe behavior rather than price alone. The narrative reaches its critical point in the transformation of the question the market is forced to answer. Instead of asking how far prices can decline, the focus shifts toward who remains willing to sell at prevailing prices, and who must secure supply regardless of cost. As the question changes, so too does the rhythm of the market. Participants who respond solely to short-term volatility often find themselves increasingly reactive, while those who recognize structural change begin adjusting their strategic posture. From an analytical standpoint, what is unfolding is not a deterministic forecast, but a redefinition of how risk is distributed. This analysis examines the intersection of fiscal policy, monetary policy, and strategic resources, and how US dollars, foreign currencies, gold, and silver are increasingly evaluated within a unified decision-making framework as the global system becomes less uniform. It is grounded in publicly available data and historical precedent, and does not constitute actionable advice. The primary value for the observer lies in a shift of perspective. When monitoring the silver market, the question is not merely where prices stand, but which forces are defining their lower boundary. When holding US dollars or other currencies, the issue extends beyond exchange rates to the role those currencies play in strategic resource decisions. And when viewing gold and silver as defensive assets, attention should be paid to how large institutions adjust behavior as the boundary between market dynamics and policy intervention becomes increasingly blurred. At present, no definitive conclusion can be drawn. The most prudent course is to observe how policy statements translate into concrete actions, how supply chains respond, and how markets recalibrate expectations. If you are following this development, the essential question is not which scenario you believe, but whether you are interpreting the market through charts or through structural analysis. That distinction itself sustains the ongoing discussion. This is precisely why the story does not end with the price of silver. When policy discourse begins to reference price floors, what changes is not merely a numerical threshold, but the conditions under which markets are permitted to operate. Throughout monetary history, when political considerations move deeper into strategic resources, economic systems adjust toward prioritizing long-term resilience over short-term efficiency. Gold and silver consistently emerge in such periods, not as catalysts for panic, but as reflections of the need to preserve purchasing power as systemic tension increases. This suggests that we are entering a cycle in which supply chains, currency systems, and technology are more tightly interconnected than ever before. And this is only the beginning. The coming months and years will reveal the extent to which price floors are implemented, how the refining sector responds, and how long-term contracts evolve. The question for you is this: How will this shift influence the way you perceive the US dollar, gold, and silver over the next 5 years? Where do you believe the true inflection point of this cycle will lie? Share your perspective. This is Money Cycles, where we examine the major movements beneath the surface of markets. If you wish to follow analyses of this nature, you know where to find us. Because in large cycles, what matters is not reacting the fastest, but understanding where you stand when structure begins to turn.